Okay, here's your scenario. You're in a position in the market, and what happens is you have an options position. You have a lot of confidence in your position. However, the market changes and it moves against your position. And this happens to a lot of people, and they often don't know what to do. And one of the reasons is because they may not really understand what we call IV crush. And what we mean by IV crush is that based on the IV that you buy, right, the IV that you purchase, and also the expiration date that you're in, if the market starts to move against that position, especially very rapidly in a short amount of time, what happens is the IV forecast gets reset and it can start to essentially eliminate the premiums of your contracts. And what can happen is that you can have a contract that can be down by 10%. And in one day, your contract can now be down by 40%. You can have contracts that can be in the money, let's say by 10% profit. You may be waiting for another 10% of profit. And next thing you know, you're down by 25% on the next day. These things can happen. And often people don't know why it happened. One, because they don't necessarily really understand IV, what we call forecasted move, right? I'm talking about the IV of the actual stock and how it relates to the IV of the options contract. And many times people confuse the two, right? And they don't understand often what they're doing when they're options trading, where you're buying premium with the goal of having the premium increase so you can sell that increase in premium to somebody else based on what they believe the expected move to be, right? And so then therefore those contracts become more valuable. So let's kind of talk about that. So here's how I would look at these situations if I was in these situations. So we're looking at Beyond Meat, right? And one thing we notice about Beyond Meat, so let's look at this on the yearly, it has pretty much gone down for a very long amount of time, right? It's just been selling down and down and down and down. Now, what we had recently was Beyond Meat did their earnings, right? So 223, I believe, was their earnings. And the earnings really was not great. It really wasn't. However, for some reason, the stock the next day opened up higher. So it closed at 1714. Let me go ahead and get rid of this real quick. It closed at 1714 and it opened the next day at 1955, got to a high of 2287, and then closed at around 18. So it started really selling off right before, started selling off that same day. But if you were in maybe shorter term contracts, right, maybe kind of out of the money. So let's say it opened at 1710, you got maybe $15 puts that maybe expire in a week. You would have gotten massive IV crush because one, you would have bought a higher IV because of earnings. Then now that you don't get that forecasted move after earnings, and you're also getting crushed because it's going in the opposite direction, you would have got a massive decrease in the premiums of your contract. However, even if you had longer dated contracts, let's say maybe 60 days out, you might still get an IV crush on your contract somewhat. And it's because that our analysis on this company is still going to be bearish. However, the market, for whatever reason, has decided to open this at a much higher price point than what it closed the day before, right? So when you're dealing with stocks that are starting to get like under $20, the percentage moves are going to be really big, even though the dollar move is going to be low. But when you get these big percentage jumps, it can really start to skew the options premium. And so this can happen. Now, there's a lot of reasons why this can happen. So when you're looking at a ticker, what I want to always encourage people to do is look at the situation in totality. And this often is not this is something that a lot of people that they only do technical analysis, they sometimes don't get this. You often have to look at a situation in totality, right? Not just one aspect of it. But if you do, then you just got to be really consistent with always just looking at one aspect. So what I mean is that if you're only going to trade off the MACD, then you just got to always just look at the MACD. You can't do anything else, right? But when you're looking at the situation in totality, what I want you to understand is that Beyond Meat has a 43% short percentage on the float. The float is 58.41 million. So the float, to me, relative to its market cap, is very low. Looking at a 58.1 million float and relative to Beyond Meat's market cap, this to me is a very low float. 43% of the shares available to the float are being shorted, which means almost half the float is being held in a short position. And what can happen a lot of times is when you get a company like this, we don't know how long people have been shorting it. So they may have been shorting this since August of 2022, right? Hypothetically, maybe they have been, right? And so now what they do is at this point, they decide to exit their short. right? Or maybe this open being higher forced them, right, to get out of their short position. Because I don't necessarily know if we can get the data on what's the price point for the majority of the shorts on this flow. If we could get that data would be almost worth gold. I don't know if that data is available. So let's say hypothetically they may have entered in their shorts at 2.2. And then what happens is it opens up higher and they just decide, well, you know what? Because it opened up out of, almost pretty much almost close to my position, it may be time to me exit my short and take some of the risk off the table. We don't know. What we do know is we got a major gap up after earnings, even though the earnings wasn't that good. However, you're in options contracts. What you would get a lot of times if you're at or around the money of this particular close price is you would get a big skew. You also would get that because normally with a ticker like this has been selling off a long period of time, the options contracts a lot of times are going to have a lot of implied volatility already baked into the contract. So you're already buying a lot of forecasted movement already baked in. So if you buy puts, let's say the IV was well over 50%. Let's say hypothetically with this instance, it was 100%. You're already buying 100% IV move, right? Baked into the contract. So then as a result, once the contract starts moving or the stock starts moving in the opposite direction, you're already going to get an IV crush just off of that, right? So that's what I want people to always understand is that a lot of times these type of tickers, until you get a little bit more experience and you kind of have to go through some things as a trader, can be dangerous because Beyond Meat most likely is going to run out of money this year, right? They got $309 million cash in the bank. They got $1 billion in debt. I don't know what their quarterly cash burn is, but it's going to be very difficult for them to maintain operations without probably doing an offer. So it's very likely they're going to run out of money probably before the year's out. Profit margin is negative by 9. Like this is a business that's just burning through money. So it can be difficult for them to attract new capital. They may be able to, but as things are going right now, most likely they're going to probably run out of money before the end of the year or maybe top of next year. Therefore, the analysis on this should be bearish, right? In my opinion. However, you sometimes get moves like this because like I said before, it's being very heavily shorted. And a lot of times you get companies that are being heavily shorted like this. Until it collapses, you can get a lot of volatility, right? On the upside and also on the downside. We saw this with Carvana. It went to like $15, went back up to 20, then one day collapsed back down to 5. You can get a lot of volatility. So this is something you want to look at. Same thing with Wayfair. Let's look at Wayfair also, right? Okay, so let's look at Wayfair. And so we're looking at Wayfair on the yearly candles, right? On the yearlies. So we see that it's sold off all the way down from, 350, right? Which is impressive. But what we're seeing is that here, right? Early January, this is kind of towards when everything got really bullish in January. It started to gap up and it got back up at 70. So if you were in a short position, let's say around here in the 30s, you figure, hey, it's going to keep selling off. It's not a really well-managed company. And you start taking put positions. It starts to move against you. And then it starts to gap up really aggressively, right? Then it starts to move up. Well, you may have to accept that, you know what? The market is moving against my position. Because what's happened is that on these gap ups, right, which is really no reason for it to be doing this because I don't believe it was even an earnings late January. You just have to accept that, you know what, the market is moving against my position, right? So you're going to get IV crush because this stock has been selling off for a very long time. The forecasted move on the sell-off is already baked into the stock. So that once it starts moving against your put position, it can put you in a position to where now you may not be able to withstand that position. Same thing with Wayfair, right? So let's look at the numbers. Let me move this right here. So what are we seeing? We have a float of 81 million. We got 42% of that float being shorted. So it's going to be very volatile just based on that. So if you get any kind of short covering, so in a situation like here, as it starts to move up, shorts are going to have to cover, which means what? It can put more demand on the stock. But then what do we see? Once it got to 70, it just sold right back down. Right. So I would look to start studying these patterns. So maybe with Wayfair, we may say, hey, because we see here, got around the 70s and sold back down. we may look to short it down from $70. But everything else, we got to be worried about volatility. What we're seeing is it's going to keep rejecting 70 to maybe 75. However, when you look at the premiums, what are you seeing? Let me go here again, my bad. There's a lot of implied volatility already baked into the contract. And so when you're buying that high implied volatility, right? Let's go see, can we get to 17th to pull up? When you're buying that high implied volatility and it's already baked into the contract on both sides, if you don't get that movement, you're going to get a lot of IV crush. If you do get the movement, it can be beneficial to you. But a lot of the movement is already baked into the contract. And it's weird that you have all these this high open interest, especially way outside of the money for next week, right? So we see those losing a lot of premium. People are buying these positions for some reason. So a lot of this is already baked into the contract, right? A lot of people are betting the 31st is going to be at 30 or under $30 by next week, right? And so what I want you to really understand, or what I'm trying to help you understand, is that you sometimes can get IV crushed because the market is moving in the opposite direction, even though that may be totally different than your analysis of the particular ticker. So let me give you another example, because everything we talked about is on the downside. So we got Silvergate, which was a company that did a lot of business with like a lot of these cryptocurrency firms. It sold down. It was trading at around the $20 mark. A lot of people anticipated it to go back up. So what you had was a lot of people buying call options thinking this is sold off so much, it's going to pop back up because of what we've seen with these other plays. But what did we see happen? Earlier last week, it came out, some bad news came out, and it gapped down from a close of 1353 and it opened at 769, right? So you got a massive gap down, and the next day it traded even lower, okay? And so it doesn't always mean, and this is what a lot of people start to think when we look at Wayfair Beyond Meat, if it's being sold off, it's going to eventually short squeeze back up. That could happen, but it doesn't mean it's going to happen. A lot of times when you're looking at these scenarios that are very volatile, they're very volatile for a reason, because why? They can go in either direction, right? So it may make more sense to play both sides of the options chain if you can afford that, or maybe come up with some type of delta neutral strategy. You won't profit as much, but you often sometimes won't risk as much, right? However, it doesn't matter if you don't understand the fundamentals of what's going on with the ticker. If you don't know, like I said, if you're just looking at it strictly technically, you don't know that I'm looking at a ticker to where 42% of the float is being short, or I'm looking at a ticker to where 43% of the float is being short, especially on a smaller float than this. It can make these tickers very, very volatile, right? And so this is how you want to try to stop not getting IV crushed. So let's kind of talk about some of the things that I would look at in this situation. So the first question I would ask myself is that, do I need to exit my position? Right? If I'm in this position and it starts to move against me, do I need to exit my position? Do I need to just get out? Because if I'm hit my exit stops, do I need to just get out? Because sometimes getting out of the position can sometimes be the best thing for us from a financial standpoint, but also from a psychological standpoint, right? Often people will try to stay in the position because now it's like emotional. I need this to go right to prove something to myself. I really wouldn't encourage people to trade that way, but sometimes until you get more experience, it can be difficult to do that, right? What is my overall narrative? Is it still intact? So even if Wayfair can go up to $100, it doesn't change my overall narrative of Wayfair, because I can look at their financials. Same thing with Beyond Meat. Beyond Meat really does not have a market for what they do, right? It could go back up to 100, 150. To me, that just creates more opportunity to me on the downside, because I'm looking at their actual business operations. However, I may not have the capital to sit in the play until it turns in the way I want to. So it means I may have to exit my position and wait for things to resume the way I want it to resume, okay? Next thing, what is causing the stock to move against my position? Do I know? Now, if I'm looking at it technically, after it moves against my position, I can say, well, this happened technically, which caused it to move against my position. But what is really causing it to move against my position? What we're seeing in this market currently is you're having days where you're just getting a lot of inflows and everything's being bought up. They're not just buying up, the top 5 companies in the S&P 500 or the top 5 companies in the NASDAQ. They're buying everything. And so they're buying the, companies that are really terribly managed along with the good companies like Apple and Microsoft and things of that nature. So sometimes, and especially the market that we're currently in now, you're having a really strong inflow day that can sometimes push you out of your contracts because that's just how this market is operating right now. We're really not seeing a lot of discrimination on either side. We have days where everything sells off and we're having days where everything gets bought in. Now, do you sometimes have individual tickers? Yeah. But what we're seeing is a lot of days is the whole market is being bought into, and then all the days where the whole market is being sold off, regardless the condition financially of that particular company, right? Next question, how much longer can I hold? So this has to do with how much time is on your contracts. You're buying shorter term contracts. The position starts to move against you very aggressively. Can you hold the position? Because we know now that the position has moved against you. They're going to reset the volatility, the implied volatility on the contract, which is going to decrease the premium. Do you have enough time to get that thing to move back in the direction you want it to, based on the time that you have on the contract, right? And if I didn't have the time, I would have to consider maybe I need to get out of this contract and just take whatever capital I can get and take it off the table, as opposed to sitting in the contract and letting it keep eroding against my position. Next thing, am I anxious about my position in the market? This is something a lot of people deal with. I've learned that if you are anxious, if you can't get sleep, if you're worried about your position in the market, I would encourage you to get out of the position because it's causing you a lot of stress. Better to go cash and keep your cash and know you got your cash than to have a position that's eroding against you. And this is what happens to a lot of people. They take too large of a position for them, and the position's not going the way they want it to go, and now they're stressed out. And this happens in every market. It happens in real estate. It happens in the car market. A guy may spend his last money buying 4 cars and can't sell them. Or he may spend his last bit of money financing the sale of 4 cars, and now he can't sell them. So now he's worried about paying the carrying cost of that. This happens in every market. One good thing about our market is because the positions are so liquid, if you do it the right way, you can always get out of your position relatively easy, right? Therefore, if I was anxious about my position in the market, I would get out of my position. I would not let the stress get to me, right? It's better that I would rationalize. It's better for me to be in cash and know I have the cash than to sit in a position that has a dollar amount attached to it and my position is eroding and I'm sitting around here stressed out, hoping that the thing turns in my position, right? Next question you could ask is for a little more advanced traders. Should I roll my trades? And what I mean by rolling your trade is that you buy the contract. You sell the contract back, because we're not talking about selling premium. You sell the contract right back into the market, and then you buy a longer dated contract, right? So you're taking a short loss at that time, hoping that my narrative is still the same. I buy more expiration, and then when it does happen, I not only get the increase in the premium of that, but I also can offset my loss that I took selling it on the first time. And that has to be determined mathematically. And some people do that. They just roll their trade out. So if they say, hey, you know what? This didn't happen in the amount of time I thought it was going to happen. So they decide this relatively early. They don't wait till the last week before the contract expires, right? They realize once I hit my exit number from a percentage loss, right? Let me decide whether or not it makes sense based on the delta, the implied volatility, things of that nature. Should I roll my trade into another trade, right? So I may be by that same strike price, but at a later expiration date, whether I'm on the call side or the put side, right? And you can make those decisions because sometimes your overall narrative can still be intact, but at that moment, the stock, for whatever reason, it can be a macro event. The stock is moving in the opposite direction of where you think it should be going. So I hope you got some value from it. But what I want to really encourage you to do is make sure that you guard against IV crush. It happens a lot because with an options contract, you are trading a decaying instrument. So the time is decaying the instrument, right? Or the actual security. And you always want to understand that, right? So unlike an equity, you don't get time decay, but you also don't get the leverage that you get in the options contract. With the options contract, you get the leverage, but you got to deal with the time decay. So there's a pro and a con in every scenario, right? But you want to always make sure that you understand how a movement against your position will impact the position you're in, and then how long can you maintain that position if it does move against you, right? And how does the expiration date impact your ability to sit in your position? Hope you got some value from it. David W. Williams, also known as Diamond Dave, and I'll talk to you later.